Good morning and welcome to this Monday, March 23rd edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, very incredibly volatile week last week. It was options expiration week. Volume soared. The volatility really was unlike much of anything I've seen in the past, maybe going back to the financial crisis 2008, certainly on a par with that. The sentiment indicators that I follow were not available back in 1987 or 1929, maybe even in the 1970s. So it's very difficult to say how it compares to that. But we can look at the acceleration to the downside and certainly say that this move to the downside in a 1 month period may not have, maybe with the exception of that October 2008 period, I don't know that there's been a period where we have seen this kind of an acceleration to the downside, how quickly we've moved from all-time highs, a very strong economy, very low unemployment, to where we are today. I don't know that we've seen anything quite like this. But the market is pricing in a lot of bad things. So there's going to be, you're going to hear news. There's no doubt about it. It's going to probably start coming with some of the economic reports. New home sales is out tomorrow, but that's for February. So I don't think that one will be too bad. We started to see a little bit with initial jobless claims that came out on Thursday of last week, where they suddenly spiked to about 280,000, but that will be nothing compared to what we see going forward. So the shock of some of these economic reports, may spur some additional selling. I think there'll be a lot of panic on some of these numbers, but keep in mind the stock market prices things in advance. So, if the economy down the road, if we can get the virus under control and the damage isn't too bad and we're backstopped by the Fed and we've got Congress working on stimulus package, the stock market could be pricing in a lot of this already. That's going to be the real challenge as we go forward, is to see whether or not what we've seen so far in terms of damage to our markets and to the major indices, has that accounted for what we're going to see down the road. And I think right now there's just too many variables out there to make that call. I would like to say, based on where we've seen the VIX and the put-call ratio, I mean, we've got the fear to mark a bottom. What we don't have is a history of pandemics in this country and whether or not, the virus is going to be contained. And if not, how much damage is that going to ultimately inflict on our economy and on our confidence as a country. Confidence can play a big role. Even though we can have a lot of devastation, if we can maintain our confidence, we can bounce back a lot quicker. So there's just a lot of variables out there to try to make a call as to whether or not we're at a low. Now, I believe I tend to have a pretty, half full view of the market. I kind of maybe have a little rosier outlook. I tend to keep a pretty positive outlook. So I still believe that if you're in this for the long term, you stay in it for the long term. And if you've been out, you're thinking about getting in. I know it's, you look at all the news and everything, but history tells us that when we see big moves like this is the time to be thinking about moving in. Now, maybe if you're sitting in cash, you're like, I don't know, maybe you just put in a portion, and work your way. Maybe it's a 6-month process that you say, hey, I'm going to maybe put it in over the next 6 months, every month, 1/6. That would be probably a constructive way to build a position over a longer period of time. Because while I'd love to see the market go straight back up, I think that's going to be, the longer the spread of the coronavirus, the more economic damage. I would suspect that it's going to be the longer period to recover from it. That doesn't mean we won't go higher. I think once we set a bottom, we'll go up. I just don't know that I'd be looking for this V move right back up to the all-time highs. I saw someone say that, we'd be back at 3,400 by early 2021. And I'm pretty bullish and I'm pretty optimistic, but that would really be quite the optimistic view of what we're seeing taking place right now. I look at the market, I see all this damage, and it tells me we got a lot of bad stuff coming economically, but a lot of it could be already priced in. We'll see. Let's take a look at some of the charts from last week and get into this. So we had the Dow Jones Industrial Average down 913 points. We were actually up early in the day, and it was option expiration day. I'm going to talk a little bit about options in a little while. But there were some moves in individual stocks, especially if you look at a pretty interesting chart. I'll show you in just a minute. But if we look at the sector, industry groups that actually performed well on Friday, they were all the groups that have, well, just about all the groups that have been beaten up so badly over the past 30 days. I mean, everything's been beaten up, but I'm talking about the cruise lines, the hotels, gambling, those types of stocks, airlines. Those were the ones that actually finished higher on Friday. And it's, in my opinion, all due to options, because so many of those industries, they were beaten down so bad. There was so much in the money put premium. I kind of just looked at the leaderboard and just kind of shook my head, as I do a lot of times around option expiration day, because those stocks were probably being propped up by market makers heading into option expiration Friday. And sometimes the option expiration doesn't just end on the Friday. Sometimes it carries over into the following week, and we'll see. But first, let me just go through this. We got the Dow Jones down 900 points on Friday, 4.5%. The S&P down 104, which was down about 4%, 4.33%. NASDAQ down a little bit less on a percentage basis, still 3.8%, 271 points. And we did finish back below 7,000. Again, as you can see here, all of the major indices were either at or setting fresh new lows on Friday. Mid caps, small caps, both down 4.5% to 4.75%. So another rough day there. As far as the various sectors go, energy, the only one finished positive. But you can see energy has been hit so hard, much harder than the others. But we did finish up. Again, this is kind of what I was just talking about. I think a lot of that had to do with options expiring. A lot of the energy names did rally into the close on, well, not into the close on Friday, but into the latter part of last week. We saw at least short-term movement to the upside. Other areas didn't fare so well. You can see utilities really got hit hard on Friday, down almost 8%. Consumer staples, 6.5%. These were both defensive groups, as is the real estate group, which was down 5.6%. And then throw in industrials, which were down 5%. So it was across the board selling. Another really bad week. This was the worst week that we've had since 2008. We had one of those 3 weeks ago. We said that was the worst week since 2008. I think the S&P had lost maybe 11.5%. This was 14.98% last week. So now 3 of the last 4 weeks, we've seen the S&P 500 drop 8%, over 11%, and then almost 15%, 3 different weeks. So that just gives you a sense how quickly things have deteriorated. Looking at the Treasury market, you can see the 10-year Treasury yield. Well, let me give you an update here. It's not exactly, oh, that's the TLT. Yeah, so the TLT is up today, which means the 10-year Treasury yield is down. So here you go, the 10-year Treasury yield right now down 11 basis points to 8.83. But this is what we've been seeing, a lot of fear at the open. So we see yields, Treasuries go higher, yields go lower at the open. See the huge gap down? This is where we opened. Opening price, 0.715, way down here at the bottom of this candle. If we look at the TLT, we got the big gap up, which we have seen so many times. Look at this big gap up failure. This one was a little bit of a gap down, but then we came down. Here's a gap up, failure, Another, this one gapped up, moved higher, equal high, down during the day, down during the day. Here was a gap up, well off the highs. So all the fear is driving folks into Treasuries at the open. But then when the opening bell rings, it's been a different market. And you see Treasury selling off, which means the yield rising, which is what we have here and what we've got so far today. And then also when you look at something like the spider, I mean, look at all these hollow candles. We don't see big red filled candles. We've had a few. We had the biggest one was Friday, actually. But other than that, you know, since the end of February, most of these candles have been hollow, meaning you're closing above the open. So it's almost like the panic is at the open. Market makers take advantage, bring the prices down, and then it's been volatile, so it's crazy volatile, but there's been a little bit more bias to the upside during the trading day, whereas it's been clear downside bias at the open. So that's, as a trader, you need to know that. Now today, it looks like we're going to gap up. The futures have been all over the place. So we had a lock limit or right up against the lock limit last night, with the market looking to open down perhaps 5% or more. And I'm just pulling up the current where we are now. So now the spider is up 2.2% this morning, looking to open up $5 to 233.85. So here we are in this chart, closing at 228.80. So right now we're looking to open, and this could change in the next 20 minutes the way the futures have been moving. But right now we're looking to open up about $5, 233. Now, from there, I mean, I would rather see a move down and capitulation, massive volume, big reversal to kind of hopefully mark a short-term bottom. We just need to base. I would really just like to see the market base. I don't know if that will happen today or not. We've seen already a lot of announcements coming out from the Fed. This big jump this morning was once again due to the Fed announcement. They essentially have come out and said, we got all the Kool-Aid you want. They announced unlimited QE. So unlimited quantitative, whatever is needed, they are ready, they are prepared to do it, which is good because, like I said earlier, confidence is a big part of the stock market. So if the market doesn't have confidence, if it's shaken, if it's uncertain, uncertainty is the biggest bad word on Wall Street. Anytime the volatility index starts to rise, and my threshold for it, as I've told EarningsBeats members many, many times and talked about it here, written about it, is when that VIX starts to get above 20, when it starts to get above 20, that's when I start getting really nervous. I don't like to trade a volatile market. I'm a trader. Some people think, oh, wow, these are huge moves. This is a great time to trade. Well, if you get it right, it's a great time to trade. If you get it wrong, you can lose a lot of money. And for me, my portfolio, my cash is my product in this trading business. Can't afford to lose a lot of cash. It's hard to get it back. So here you can see back on, it was back on February 24th, and I think it was the 24th or 25th when I wrote to members and said, hey, this scares me. I'm scaling back my trading. I'm definitely cutting way back. It's time to think about fewer positions, smaller positions. And that happened back February 24th when we went above 20. I think I wrote about it. I've got an article here in February 27th. Talked about, the fact that, we were starting to see so much more fear in the market. So here was the equity only put call, very complacent, but it was really building. So I was wondering, how high is this going to go? Well, I want to look at the chart now. Look at where we went. We were down here. So when fear starts to grow, and look what the S&P 500 did. When fear starts to grow, you have to acknowledge that as a trader, not as a long-term investor. Long-term investor, you're not sitting there saying, when the market's going up, you don't get a lot of questions about, should I stay in? Everybody just assumes that when it's going up, everything's good and it's fine, and I'm a long-term investor. When push comes to shove, you start getting a lot of volatility. That's when, you start questioning, okay, should I continue holding? And so no one questions when it's at 3,400. You question when it's at 2,400 or 2,800, after you've taken a big hit. And so what changed? Well, what changed is fear. That's what changed. Your strategy, if you look out 20 years and you're all the way back up, let's say the S&P in 20 years is at 10,000, I don't know. Looking back, this would be a blip on the radar. But when you're actually experiencing the blip, it's fearful. So you've got to decide, are you long-term trader, are you short-term or long-term investor or short-term trader? The other thing that I posted in this blog article back on February 27th was the S&P 500, showing you a couple levels. Now, as the market starts getting more fearful, I put in a couple areas to be thinking about. One connected most of these lows, with the exception of that 2018 drop, which I think was triggered in large part due to the Fed completely getting it wrong there. But we came right back up, and so that line was holding, and it also coincided very closely with the breakout at 3,025. So I was thinking, okay, this could be a level where we might, look for a reversal. Well, that didn't hold. The next level you can see right in here was that low in 2018 at 2350. Also, if you take the same slope from the highs and use that same slope on that low from the bear market low, March 2009, that would bring us to about the 2400 level. We closed just below that. Now, how far could we go if we can't get back up above 2400 here and hold it? I would be looking down at 1800. I think that, we're talking about fear. This isn't rational. You might say, well, that's 500 more points. We can't do that. Well, another 15% week would be 400 or close to it, 350. So, when the market's fearful, yeah, anything could happen. Again, it's not rational. Yeah, technical analysis is the rational study of price action. This is not rational. So those who say, well, see, technical analysis doesn't work. Well, technical analysis is not going to forecast a global pandemic and the fear that results from it. That's not going to happen. This all came about very suddenly. It was nothing that anyone could have anticipated in 2019. So we're reacting, and as technicians, we react. The problem is, for me, technical analysis, when the VIX is at 70, 80, even 50 or 60, technical analysis, I throw it out the window. I'm looking at the fear readings, the sentiment readings. That, to me, is the most important thing to watch right now. Now, yes, a major reversal at a key support level with extreme fear, yeah, that's technical as well as, studying the sentiment readings. So anyway, so the Fed comes out. They've announced unlimited QE. That's awesome. Another story that came out late Friday night. There is a company in the medical equipment area, which is Danaher. You can see, well, it's not showing right now, but stock was up last time I looked. It was up about, I want to say $15 in pre-market, something like that, maybe 11, 12%. Late Friday night, the U.S. Food and Drug Administration, FDA, approved the first coronavirus test that can be conducted entirely at the point of care for a patient and deliver the results in 45 minutes. That's a pretty big deal because that enables, especially if they can produce it in mass quantities. But that could, if there's one thing that I think most everyone would agree on, that's maybe we've been behind the curveballs on testing. So that was a pretty big announcement on Friday night, and Danaher is the company. I think the drug is Cepheid, or I'm probably killing the pronunciation, but CEPHEID, something like that. But anyway, I wanted to let you know that was a pretty big announcement that came out Friday night. The stock, surprised we were not getting that pre-market here. Well, anyway, it's not coming up right now, but that was one piece of news. Us also, certainly more of a downer for sure. New York now has more cases than either France or South Korea. So we definitely have a massive, major hotspot in in the most populated part of the country in New York City. And seeing some of the pictures of the streets at Times Square, I mean, if you've seen that, it looks like a ghost town, which is good. That's what we want to see. It needs to remain looking like a ghost town for a while. Everybody needs to be safe and back home and staying there for a period of time. Let's try and do everything we can to slow down the spread of this virus. All right, so let's see. What else do we have for today? Well, how about looking at some of the groups that, well, let's just look at the sectors versus the S&P 500. So technology continues to be good. Now, when you look at their chart, here's the absolute chart. Technology is not doing well. It's doing very poorly, but it's holding its own, and it's actually been outperforming this year the S&P 500. So you're going to find better stocks in that area because that is at least while all the money is being sold, some of it on a relative basis is finding its way into technology. Consumer discretionary has been struggling. No doubt, I would expect that. I think this is the virus is something that's going to impact a lot of the consumer discretionary areas. Communication services, though, look at this breakout. So again, on an absolute basis, it's horrible. But on a relative basis, we're seeing a lot of money moving into the internet area on a relative basis. Industrials, not good. Financials, not good. Healthcare, look at the move in healthcare. That kind of makes sense with this being a healthcare issue. Consumer staples, doing extremely well on a relative basis. Real estate has kind of fallen apart. It was doing well, but all of a sudden the past 2-3 weeks really been rough for real estate, probably the last 2 weeks. And you can see the huge drop here over the last couple of weeks in terms of the absolute drop. Utilities, we're doing pretty well, but here in March, they're actually falling a bit. Energy, just horrible. Materials, better than energy, but also been in a long-term downtrend. Not looking particularly good there. All right. Tell you what, I want to show you. If we go into the industry groups, I mentioned earlier what was leading the market on Friday. I want you to take a look at this. So I've talked about, even though internet's been down, you can see internet performing pretty well. Last week, only down 3%. On Friday, only down 3%. So just looking at Friday, but the market overall was down 4.5%. So relative strength there. But look at the groups that actually gained on Friday. Gambling, look at the scooter scores. 21, hotels 24, recreational services, think cruise lines, 2.7 scooter. These were the areas that went up. Now, I'm not thinking that's going to be a long-term thing. What I am thinking is that there's been a lot of movement to the downside, huge movement to the downside in these areas. And there was a lot of in-the-money puts. And so you can kind of see, this is almost like a poster child of, look at autos. Autos have been hit really hard lately. Travel and tourism, a lot of the low scooter ranked industry groups performed much better on Friday. And this is where they closed. Many of them were up a lot more than this intraday. And I'll talk about that just a minute. Tires, scooter of 10 comes roaring back. Look at it, by far the worst group in consumer staples. That was the only one that did well. Look at all the energy. Most of the energy did pretty well on Friday relative to the market because they've been beaten up so bad. Again, I believe a lot of it was option related. Let's see, airlines, scooter 5.6 finished positive. Trucking was the exception. On a relative basis, trucking's held up pretty well, but it was up. But a lot of these other groups, aerospace, only down 2%, was up much more during the day. So, when you look at this, it makes sense based on how the market works when you get into options expiration. Not at all shocked. In fact, some of the groups that have been doing much better, I think, struggled a little bit more. When you look at non-durable household products, 91 on the scooter, lost 7% on Friday. Some of these stocks had actually performed pretty well with the coronavirus issues and scare. And so they had a lot of in-the-money calls, net in-the-money calls. So I saw some of those stocks coming down on Friday. And I'm like, wow, the good are being taken down, the bad are being propped up. And that was all for options expiration. So just a little window dressing as we wrapped up options for March. Okay, let's see. What else can we get into? Not a whole lot of earnings stuff going on, but what I will say is that we've got a couple of reports coming up later this week. Nothing today, but later this week, we've got Nike coming in. And I'm looking at accumulation distribution as well as relative strength. So Nike, was down about 40% in a month, but it did start to show a lot of hollow candles in here. And you can see its accumulation distribution actually broke out. Now, remember, accumulation distribution is based on volume. So anytime you have massive volume like this, you can make a big change in your accumulation distribution. It just depends on how you finish each day. Here you can see Nike was finishing pretty strong most of these days, lots of hollow candles, and as a result, it's been, moving up. Going to be a lot of interesting earnings reports coming up. This is one I would certainly watch. Another one would be Micron. Micron will be reporting later this week. Another big move down. Now this one, accumulation distribution. I've seen a lot of technology stocks with good looking accumulation distribution, not seeing it as much with Micron. So that's a little bit of a concern, I think, heading into this report. Lululemon, LULU. Now, this has stayed very close to a high on its accumulation distribution. And even though it's been very weak and clothing and accessories has been very weak, Lululemon's been a strong performer within the group. So everything looks bad. You look at Lululemon, you're like, wow, it's been a horrible stock. But when you look at it on a relative basis, money is still rotating into that stock within the group. And it's showing, if I go back to the other chart, it's showing fairly good accumulation distribution. It's not perfect, but it's up near a high. So, and it got beaten up. We saw a rally, a lot of it probably options related, but there is some solid accumulation distribution numbers here. Anyway, so those numbers are going to be coming out later this week. Also, we've got a home builder coming out. This is a group that has just been shredded, like they're never going to build another home again. KB Homes, $40 1 month ago, went below 10. I'm interested to see what they have to say. And when you look at the accumulation distribution, this one is actually at a low, about a 5 or 6 month low. We did get a little pop on this reversal, but you can see there was a lot of movement to the downside here recently. Big volume, big moves. It was actually holding up okay here until it broke down below $32. And that's where we've seen this actually confirm this move to the downside. So KB Homes, I'd be watching that report. I'm not really going to spend much time here on upgrades, downgrades. I mean, Boeing upgraded, Coke upgraded, CSX upgraded, Netflix was upgraded, Lennar, a home builder, upgraded, Pepsi upgraded, downgrades, AbbVie, it's a biotech, ABBV, Bed Bath & Beyond, Bristol Myers, Honeywell, Starbucks, Tandem Health. Those were some of the names being downgraded. I want to show you some of these stocks, and we're going to run a little over this morning, but I think I'm okay with that just because we've got so much to talk about. I'm going to pull up one of the stocks that this was the top gainer on the S&P 500. CCL, top gainer on the S&P 500, up 20% on Friday. It's a miracle. Stock hit a low. I'm going to go to a 5-day chart. CCL hit a low of $7.90 back on Wednesday. Want to know where the max pain was? Max pain was at 18. That's where basically in the money calls and in the money puts offset one another. Some use max pain as the point at which the least amount of options are paid, which is a little different because I'm looking to see where the value offsets. Some use max pain to just say at what price point do I pay out on the fewest number of options? And it's usually a little bit off, a little different than what I use. I think either one is fine. It's just your own personal preference. But the point here is when you get a stock this far beaten up, heading into options expiration, and you could have looked at this, a week earlier, and it still would have been looking like it should have been moving higher, and it kept moving lower. I think that the risk diminishes trading these stocks as you get closer and closer to option expiration because time is running out. So if you'd gotten in the beginning of the week at 17, you would have looked at this 2 days later and said it's at 790, max pain doesn't work. But look what it did heading into options expiration. I'd say it absolutely worked. But if you choose to get in a week ahead of time, I think you're taking a much bigger risk. I think that this is a better indicator or better thing to use if you're a short-term trader as it gets closer to options expiration. MGM, let's take a look. MGM, recent low, 590. I went ahead of myself a little bit. 590 MGM. The recent high right here, 1116. 590 to 1116. Max pain was $16. It didn't get there, but what I use these max pain calculations for is a directional clue, not a let me get in at 590 so I can get out at $16. That would be wonderful. And to be honest, if I'd gotten in at 590 and the next day I was up at 7 or 8, I probably would have gotten out. I mean, I don't know how high it's going to go, but I would have been so happy to have taken that and trying to get in at the exact bottom. That wouldn't have necessarily worked very well either. Probably on this major move down, you wouldn't be thinking, oh, yeah, I'm just going to jump in here. 590 is the bottom. Yeah, I can look back and tell you 590 is the bottom. So to get in 590 and get out at $11 is probably not that realistic, but you certainly could have traded the stock. UAL, I'll do one more here. Actually, I'll do two more. UAL, same thing. This was the one down to 1780. Max pain was 39. A day and a half later, it got to 30 and change. Directional move, that's what you're looking for. And I'll do one more, Tesla. And Tesla, this will be the first of the three you must see. Tesla, big move up. Down here, 350 low. Max pain was 497. We got to 477 before pulling back. Now, do I think Tesla's ready to soar now because of this big move? No, I think it was manipulated. I think we easily could go back down Tesla. I'm not saying we're going to, but I wouldn't be surprised. You know, Tesla, automobiles have been absolutely horrible. They're getting hit very hard as part of this coronavirus scare. All right, so that was one of the three you must see. I'm going to show you another one that was hit. How about Wynn Resorts? Got down to 35 and change. Max pain was 78.50. Day and a half later, hit 60. And then finally, and then pulled back. But another one, huge move up. Directional move. Not saying it's going to, not saying it's going to go to 78.50, but there were opportunities to trade this on the long side, which we haven't seen too many of those in the past few weeks. Wynn has been, under a lot of pressure. And then the last one I want to show you, just in case you think that max pain only works on stocks that are getting beaten up, look at Clorox. Clorox, and I'm going to do this over 10 days so that you can see how much Clorox had been going up. With the coronavirus scare, a lot of people wanting these Clorox wipes, disinfectants and so forth. So a lot of demand. The stock went crazy, 160 to 215. Clorox probably never seen a move like that in its entire history over a two-day, three-day period. I mean, that was crazy. But max pain on Clorox was down around 177. We closed on Friday at 177. So it works both ways. All of a sudden, Clorox couldn't get enough Clorox around Tuesday, and you'd think by Friday, anybody jumping in on the height, if you weren't paying attention to max pain, you jump in, you better have a stop. If you are paying attention to max pain, you need a stop in play, because if it gets away from you, it could go toward that 177 level, which in this case it did. Anyhow, that's it for today. Market is open. Let's just take a quick look and see where we are. Already back in the negative territory. Again, for me, and this is just my opinion, I think the market knows the Fed is going to be there. I think the market knows that the Congress is going to pass a massive stimulus, maybe one of two or three. This is probably just the first one. The Fed, just keeps coming back. The market knows about those things. What the market doesn't know is the containment of the virus. I think that is going to be the turning point in the market. When we begin to feel like, okay, it's a little bit brighter, maybe the number of cases drops in New York, or I don't know what it's going to be, but I believe it's going to have to do much more with the virus than it is our reaction to the virus, if you know what I mean. Just my opinion. Anyhow, be safe out there. Take it easy. EarningsBeats members, I'll be getting back in touch every day with the daily market reports, keeping you up to date. And I also have a chart list of stocks that are really strong with the accumulation, distribution, and relative strength that I'll also be sharing with members this week as well. Take care, everybody, and see you tomorrow at Stock Charts TV, back here with Earnings Beats on Wednesday. Happy trading.